it going? My name is Joshua Stanton. I'm the mortgage dude. And today I'm with Dave Herbst. He's the VP of Finance for the All-in-One Loan. We're talking about the All-in-One Loan. If you haven't seen one of our videos, it's a huge deal. It's really a solution to the mortgage problem. Thanks a lot, Dave, for joining me again.
Joshua, thanks again for having me.
So again, want to just get right to it. Would you please tell us a little bit about the background of the All-in-One Loan and how the All-in-One Loan works for people?
Yeah. So the All-in-One Loan is a privately secured loan that we pioneered 16 years ago, a little over 16 years ago in 2005. It's different. It's structured to help people pay down their mortgage balance faster, safely, securely, and comfortably without any change to their spending habits or lifestyle. And it does that due to the structural changes that we implemented. It is part mortgage and part bank account. Technically, it's a 30-year draw home equity line of credit that powers the financing you need for real estate, whether you're making a new home purchase or just refinancing out of an existing mortgage. That is accomplished through the 30-year draw home equity line of credit. Josh, real quick, it's the only 30-year draw home equity line of credit available in the United States today that finances real estate. So it's a phenomenal tool. But what makes it even more powerful is that it comes with a linked personal checking account. And the checking account actually serves as what's called a sweep account, where it automatically sweeps deposited money into the HELOC in order to reduce the principal balance. And it does that the very day you make any deposit. It also keeps money available for use, for everyday use for over 30 years. So, and you do that just by using the ATM debit Visa cards that come with it. You could write checks, online banking and bill payment. You can link external accounts to it. So it really consolidates your banking activity with your mortgage debt so that you can reduce the size of your debt and avoid a whole lot of costs that typically come with it.
Dave, I get this question all the time, and you mentioned a part of this this product kind of works like a home equity line of credit. I kind of cringe to say that because it's just so much better. But can you explain really the difference? And I know this is a loaded question, but the loaded question, the difference between a traditional HELOC and the all-in-one loan, because there are a lot of little differences.
There are, and each of these may seem minor, but they're not. You add them all up, and it actually adds up into large differences and large savings opportunities. Let's think about a traditional HELOC, and I think most of your audience and most of the United States is probably pretty familiar with what these look like. Traditional HELOCs historically have been sold in second lien position. They also have what's called a 10-year draw period, meaning that you're really only liquid for 10 years. And then after that 10th year, the loan converts and the payment structure changes, generally from an interest-only required payment to either a balloon payment or an amortized P&I payment for the next 15 or 20 years. And a lot of times people experience payment shock at that point. And the other part about traditional HELOCs that people are used to is that they generally compute interest based on your average monthly balance. Okay, so what makes the all-in-one loan home equity line of credit so different is that, number one, it's in first lien position. It becomes your primary mortgage, the only mortgage on your property. You use it to pay off a conventional mortgage and potentially a HELOC. We'll get those out of the way. Those are archaic tools. It takes first lien position, and you utilize it to manage your debt. And the way you do that is through the engagement of the checking account by using your own idle money, your income, your flow of cash in and out of the tool. So the second thing that makes it very different is the way the interest is computed. The interest on the all-in-one loan is computed nightly based on the unpaid principal balance that you control, the client controls, through their deposit withdrawal activity. So it's recomputing every 24 hours over 30 years. There's never a restructure or a conversion of your payment. There is no balloon payment, no prepayment penalty, nothing like that at all. In other words, your deposits are principal. Interest is computed on what you owe at the end of the day on your principal balance. Each day's interest is totaled up once a month ends, and that becomes the interest payment. So this really separates the P from the I, if you will, the principal pay down from the interest payments. Even then, when interest after the month ends, the cumulative daily interest from 1 month isn't actually due until the 21st of the new month. It's 21 days in arrears. And that interest payment is actually drafted from the home equity line of credit automatically. So the client doesn't need to send away money or write a check or do anything. They don't have to lift a finger. It's all fully automated. I would say that the most obvious difference between this and a traditional line of credit is that the linked checking account, how you actually utilize the HELOC and engage your debt is through the checking account. Traditional HELOCs may be offered through a bank that they can help you link a checking account to. But this checking account that comes with the all-in-one is what's known as a sweep checking account. It utilizes 100% of your deposited funds and sweeps those dollars into the HELOC to pay down your mortgage balance in its entirety. If you deposit $1 today, $1 will transfer sweep to the HELOC, paying your balance down by $1, and then interest recomputes on that balance, that new balance. If you deposit $10,000, sweeps from the checking account today to the HELOC and pays down your balance by $10,000. If you owe $100,000 and you happen to have $100,000 of cash on hand and you deposit it into the all-in-one loan checking account, it'll sweep from the checking account today and pay your balance to zero, right? And interest recomputes on zero, which equals zero. So it's a phenomenal tool. You don't get any of those characteristics with the traditional HELOC. At the end of the day, a traditional HELOC is really engineered and sold as a leveraging tool. You leverage debt. You take on more debt than you started with. Behaviorally, we tend to refinance out of it, consolidate that debt into a larger mortgage downstream. And that just continues to
words out of my mouth.
Yeah, just kicks the can down the street, right? You're now extending the life of your mortgage. And with it, you're adding unnecessary cost to your life. Well, what if you got it all packaged up into one, right? You didn't need to continue to refinance. There wasn't a 10-year limit on draw timing. You had full 30 years to use it. What if the loan was actually accelerating the reduction of your balance and you were paid off maybe in 8 or 9 years, but you could continue to use the line of credit freely over the remaining 30-year term? It's just a phenomenal tool for people that are a bit more disciplined with their cash flow. They're cash flow positive generally on a monthly basis. And they just essentially set financial goals, and they're disciplined enough to try to obtain those goals along the way. It's an awesome tool, and everybody should know about it. I
agree 100%. You totally stole my next kind of point. Is that people do come to me fairly often. They're like, I've got this HELOC problem. Well, we're here to solve the HELOC problem. Totally. And it's the all-in-one loan. And if listeners have any questions on the all-in-one loan, or if you want to see a personalized simulation showing how this loan can change your life, you can get in touch with me directly at jstanton, that's STANTON, at cmgfi.com. And I'd be happy to talk to you about it and take you through that. Dave, thank you so much for your time talking about the HELOC and a couple specifics. And thank you. Have a great day.
You're more than welcome. Thanks, Joshua.